course. How many people took the Principles of Value Investing course also? Oh, good. I have some good news for you. This is a course in listening to the best practitioners out there, an extraordinary range of them, starting with tonight's speaker. And therefore, what your assignment is going to consist of is you have to, for every speaker, send to the TAs questions that you thought ahead of time would be useful and enlightening questions to ask the speaker. Now, you don't have to send them all the time, but by the end of the semester, you have to have produced at least 3 what the TAs regard as good questions. And if you do that, you'll get an HP. All right, now, there is an alternative to that. Some of the speakers will actually ask you to evaluate particular companies or particular ideas. Now, the questions, by the way, should be based on their holdings, which you can typically find online. If a speaker assigns a company to look at, you can do a write-up on that company. The write-up will substitute for one good question. The reason the one-page write-up is better for you is that it merely has, as you know from last semester, to be adequate. The questions have to be good. So actually what you need is a combination of write-ups and good questions that amount to 3, and then you get an HP. To get an H, you have to do a paper. The paper has to be on, what's the due date for the paper, Ben? 22nd. The 22nd of April, right? The due date of the paper is the 22nd of April. The reason it has to be that early is that we have $5,000 in prize money. I think it's 5,000. Maybe it's 3. Anyway, we got thousands of dollars in prize money to give for the best paper. Sometimes we give like 500 to runners-up. In order to do that, we have to have the papers early. We pick the best ones, and we give them to outside judges who are good investors who will pick the winners, and they will be announced the last day of class. If you do a paper, what you have to do with the papers is email them to me. You send them to the TAs, it won't do any good. I am actually going to look at all the papers because I've got to validate them for judging. Again, the standard is to get an H, you have to do basically an H paper. You have to do a good paper. But if you get an HP with just good questions and adequate write-ups. Is that clear? Any questions about that? Yes.
Can that overlap with our intro?
Yes, that's the good news. If you do that paper, the grade will be a twofer. It will apply to the Intro to Value Investing and this class. So if you're planning to do it for the Intro to Value Investing, thank you for that question. You get a free ride in this class. Any other outstanding questions like that? All right, there are no texts for this class. This is a class in listening. You will be exposed to a very wide range of sensible application of value investing principles. Often the speakers will give us material ahead of time and we will post it on Angel. So other than the questions, and that's where you'll see if they want you to look at particular companies, your responsibility here is really just to check Angel to see what material has been given out. And I think that is it. Yes?
Could you give some guidance on what's a good question as opposed to saying adequate question?
And all right, a bad question is, how did you get so rich? Or why are you so wonderful? A good question is a detailed question about a particular security that one of these speakers owns. Now, I'll give you an example of a good question that has produced in this classroom an answer that nobody else is aware of that is really useful in the world. As you know, we taught you last year to evaluate growth companies in terms of a prospective return at the existing price, not to try and guess what this, quote, value is going to be for those returns. That was based on Warren Buffett's answer to a question posed in this room, which is, when he invests, what sort of return does he look for? And he didn't say, I don't look at a return, I look at a value. He gave people a number. And that number is 13%. Now, Glenn Greenberg, since people now learn to ask that question, Glenn Greenberg looked for 15%. If you're disciplined and you get a good return, it turns out both of them performed above 20% for Buffett for many, many years. That's a good question. What you're trying to do is extract from these people the information that makes them successful investors. The more specific and focused the question, therefore, the more you're likely to find out. Now, it also helps to read the articles that they've written, because a lot of the questions you can probably write the answers to before you ask them. So in the Buffett-Gates thing, all of it was scripted. I don't think anybody was surprised by any of those answers. Does that help at all? So specific questions about companies, specific questions about investment processes, specific questions about risk management. Okay. Tonight we are especially privileged to start with one of the great value investors, who is Mason Hawkins. What characterizes him, apart from, as all the people who show up here will be characterized by, which is an outstanding record, is he is from Memphis, Tennessee. He and Elvis Presley are probably the biggest products of Memphis, period. But what that means, among other things, is you do not have to be in New York to be a successful value investor or a successful investor. And there is some evidence that being outside New York helps you keep your distance. I don't think Mason needs much more of an introduction than that. Mason.
Thanks, Bruce. Honored to be back in Graham and Dodgeville. For those of you that were here last year, I offered a apology. For didactic pursuits to be successful, repetition is often necessary. So this promises to be redundant.
Mason, I'll now tell you the good news. All the people from last year graduated.
Well, that means probably my friend Bruce Greenwald and a family member after here again. You're a very fortunate group because Bruce has condensed for you in a semester what we've taken a lifetime to learn. Also, you could not have two better core texts than The Intelligent Investor and Value Investing from Graham, Buffett, and beyond. We believe there are 6 fundamental requirements to becoming a successful investor. 1, sound philosophy, a roadmap for good decision making. 2, an extensive search strategy. 3, and this is kind of an affiliation of this course, the ability to value businesses, assess managements, and to weigh competitive advantages. 4, discipline to say no to non-qualifiers. 5, patience to wait for the right opportunity. And 6, courage to make a significant investment at the point of maximum pessimism. As John Templeton was wanting to say, or when almost no one agrees with you. Ben Graham's The Intelligent Investor provides the roadmap, and the specifics are outlined in chapters 8 and 20 of the 4th edition, which is the one I hope you have a copy of. The proper temperament and attitude are paramount. Everyone in this room has a required intellect. In our shop, we often discuss whether someone, quote, gets it, meaning do they understand the 3 main tenets that Graham pounded home in The Intelligent Investor. The Mr. Market parable describing how schizophrenic shareholders misprice businesses and how you should be intellectually and emotionally prepared to take advantages of the extremes of greed and fear. 2, that you need to view buying a stock as purchasing a percentage interest in the company. 3, that only by purchasing at a large discount from conservative assessment of intrinsic value can you secure a large margin of safety that's necessary for the protection of your principal and also the guarantee of an adequate return. Every investment needs to qualify quantitatively and qualitatively. Quantitatively, we want to buy businesses at less than 60% of conservative values. Qualitatively, and this is a long sentence and incorporates both. Qualitatively, we want companies that are competitively entrenched and managed by shareholder-oriented, trustworthy, confident operators who also wisely invest in businesses' cash generation. So, we want a really competitively entrenched enterprise. And secondly, we want a management that can do all the things that you're studying. Grow the sales, get the cost down, get the margins up, generate the free cash flow, and then once you've done that, wisely invest. Bruce has probably told you there are only 5 choices when you get to that reinvestment function. And how you choose amongst those 5 is critically determinative of your ultimate outcome. Value good. The 5 are, of course, putting the cash against the debt or building it up in the equity. The second, of course, would be maybe just to hand it to us in cash. Thirdly, reinvesting in the earning enterprise itself, increasing the capacity to deliver more services. Fourth, and the fourth one scares the heck out of you, which is making an acquisition. And the reason it scares the heck out of us is because the seller always knows more than the buyer. And you don't find out about those problems until you close.
Mason, could you turn up the volume a little? I think your microphone went off.
How about now? Hello?
Better.
Is that better?
Yes.
And the fifth choice amongst those 5 capital allocation options is share repurchase. And clearly we look often to the 5th as being the hurdle by which the others should be decided. Clearly, if a business is at half of value or less, in the open market, share repurchase offers a terrific return and very low risk. And so the others should be weighed against the latter. But quantitative and qualitative qualification before you make an investment. However, quality aside, Graham said 99 of 100 companies can become investments if their prices are discounted enough. Conversely, the best monopoly in industry becomes a speculation if the price is too high. Price matters in what we're doing, investing. Parsimony and investment profits are highly correlated. Our search strategy is built on a foundation of individual opportunism and capitalism. Even though we have offices in London, Singapore, Tokyo, and Memphis, our 10 analysts, or owner-operators as we like to call ourselves, who must keep all of their equity savings in the Longleaf Partners funds, can look anywhere for any company all the time. Our librarian acts as a referee on our kind of first-come, first-served system. We have no industry assignments, so everybody's a generalist looking for a great company at a cheap price for good management. We don't care whether businesses are big, small, foreign, or domestic, just that they're high quality, run by honorable, talented managers, and we can steal them. We've used computer screens since our founding, and today, for example, one provides us the new low list in every market around the globe every day. Flashes of light. Maybe looked at this one. on have an appraisal and do rough work on it quickly. We go through value line carefully, and we've done that forever. And it may sound basic, but on a number of occasions when I've ventured to Omaha to sit down with Mr. Butler, and he'll ask you, a question about a company and what you think, or what company really motivates you these days. And if you give him a name, he's often really quick to turn and grab that value line. It's a 20-year perspective looking for free cash flow, share accounting, margins, and returns. And so it's a great repository for a lot of data. In spite of the myriad of data points that you can get on your site. The old S&P tear sheets used to be our stock and trade against more extensive. They were more extensive than value line. Our team members are prolific readers like Forbes, Fortune Business, Barron's and Journal, Financial Times, trade journals pertinent to industries that we understand. We have 2 master wish lists, one international and one that's domestic companies that we think encompass the 400 or so best businesses in the universe around the world. These companies, we keep our appraisals current and we can compare their prices to their values. Each time we visit the management, we always ask, quote, who's your best competitor and why? Our best insights never come from reading K's and Q's and quarterlies and annuals and prospectuses, proxies, that which is readily available. Every 3 months or so, we check the 13 F's of respective competitors, hoping to find something that we've missed. So that just gives you a few of our ways that we do our screening and try to percolate up ideas that we might not think about.
Mason, can I ask you, who are the 13 F's you look at?
Well, Bruce, we might look at one of your associates in the board, but we have special people that we think are very talented, as John Dickerson and Seth Coleman. Wish they was a little more close friends and have done for a long time. A few people in the hedge fund world that we very respectful. People that do their own work. People that hang numbers on companies and assess the quality of those companies. So far, what I've described is a process where we search globally among a worldwide universe of some 4,000 companies. We also look at all parts of the capital structure within the company, not just the common, but prefer the sub-debt, the converts, the senior debt, the mortgages, the bank loans, for the best risk-return opportunity. Bruce and I are briefly speaking in the elevator coming up about how in the last couple of years the debt markets provided certainly equity-like returns, but unequity-like risk and great privilege. Being first to the line when you're getting the assets or the cash flow. On requirements number 3, we value businesses 3 ways. A, we determine what the company would be worth on the 4 health steps by rewriting the balance sheet, adjusting historical cost accounting for today's values, and getting an asset value. We've made a lot of money that way over the years. And it's pretty pedestrian, but it can provide huge profits and low risk. In the Graham and Dodson newsletter, some of you may have read, we talked a little bit about Burlington Northern and in the early 80s, I think it was. We bought Burlington Northern when there was a strike. It was not making money. There were 5 people on the train, and it was 10 cents on the dollar because they owned 6 million acres of land given to them for putting the railroad across the country. 6 million acres of land was on the balance sheet for 0. And underneath that 6 million acres of land was coal, the tundra and the cave, the gas, the oil, the barrels, the MCFs, the gold, and the timber that stood above those 6 million acres. Not to count the higher and better use real estate to two major cities. So it was just very simply an addition division exercise, and the math is not accurate per share, but at the time it was about $100 for about $10 cost because it was losing money. And Wall Street was up in a tizzy because it was losing money. We needed 2 or 3 at most people in the train to make money given the recession, etc. But anyway, as you know, fast forward, you got 4 companies, and you got more repair. You got more El Paso Natural Gas, Burlington Resources. I forget the gold company and various parts of the real estate industry things. So under methodology number 1, you go to the balance sheet, you figure out the worth liquidation, or you determine what net asset value is. B, for competitively entrenched enterprises, I want to underscore that, we conservatively calculate the company's ability to produce free cash flow and then value the future stream. We determine current free cash flow, i.e. net income plus depreciation, amortization, for taxes, and get gross cash flow, and from that we take required capex and the working capital that feed the business out to get a current free cash flow stream. We take it out 8 years or so based on our very conservative assessment, usually never more than the past is giving you terms of growth rate. We put a terminal multiple on it out there 8 years, no more than GDP growth at that point, and we come back at a very conservative discount rate, no less than 8. And again, you need to be very careful only put this methodology on businesses that have huge competitive advantage, that have predictability, and so that you're not putting bad data in the box and getting even worse turnout. Thirdly, we compare each balance sheet and/or free cash flow appraisal to our long-term database of comparable business sales, ones that we adjust for the interest rate environment in which those transactions occurred. After making the comparison, comparable sales to say DCF or net asset value, we take the lesser of the 2 numbers, our appraisal versus the comparable sale watched it. So again, you're trying to satisfy the guy or the girl you see in the mirror in the morning, and you want very conservative inputs on this quantification of the company's intrinsic value. We think it helps to draw a picture of how compounding works when investing in a qualified publicly traded common equity. It's up to the analyst, i.e. the investor, to plot the top line. And if Kevin can help me out, we'll give you a graph here. And I'll say that we've got 5 years on the graph. Every year has 4 quarters. Every quarter you get a new 10Q, quarterly, and it allows you to replot your assessment of intrinsic value. And that's the blue line. And we've given you an example here with the retention of free cash flow. Maybe this is Aon. The company is capable of growing its intrinsic value 12% a year. And so through time, you're applying this intrinsic value growth. The red line happens to be a very inefficiently priced common stock at the left axis at the beginning of this 5-year period. And as you can see, if you're very careful about only buying something at half the value accretes 12% a year, and if price rises to reflect intrinsic value in the 5th year, you get 29% per annum compounding. This picture is really valuable, and it's kept us thinking clearly for 35 years, we think. If you paid fair value and all you got was the accretion of value, you get 12%. If you bought at 50% of appraisal, you pick up another 17 points a year of compounding, i.e. 29 versus the 12. But more importantly, based on Ben Graham and Dodgeville, you sleep really well at night. You go to sleep every night knowing the blue line's rising, and at some point the scales of economic justice are going to get you paid, because Mr. Market will weigh that blue line fairly in time. And that's just a predicate that you have to believe. And we do to our core that Mr. Market figures it out in time and weighs this bond-producing coupon fairly. And as that coupon gets clipped, it's reinvested in the enterprise and the intrinsic value grows. So therein lies the important link to good management. They need to produce the coupon and they need to then retain it intelligently, choosing amongst those 5 choices I told you earlier in order to even give you a more upward sloping blue line. So this is what we think about. We think about the blue line almost predominantly. The red line tells you nothing about the ultimate outcome. It tells you nothing about the business, their competitive advantage, nothing about the quarter model stuff that you know about. And so your focus is on the blue line and the perpetuation of its growth, the threats to the blue line's upward sloping tilt. And so if you're right on the value on the left-hand axis and the company's worth 40, you pay 20 for it. If you're right about the qualitative assessment of the business and its ability to produce free cash flow return for your benefit, you're going to make a world of money with very little risk, because the value is always more of the price that you paid until Mr. Market achieved. Discipline and patience. On the quantitative front, as we've said, we want stocks at less than 60% of conservative appraisal. If we can't find them, we're happy to earn T-bill yields on our cash, even if it takes us a couple of years to find a qualifying common stock. We've been served well to wait patiently for them. As Charlie Munger says, quote, things show up. We always want to be in a position to be a liquidity provider, never in a situation where we're forced to look for cash. We don't have any debt in our personal lives. We don't have any debt at Southeastern. We don't use debt in our portfolios. Our investees are mostly debt-free, very strongly financed. So in all 4 of those, we hope to be in a position to be a liquidity provider. If you study all the great investors, from the Medicis to the Rothschilds, the Morgans to Buffett, you will learn that they were always patient and in a position to provide cash. Courage, an unassailable philosophy, a comprehensive search strategy, the ability to hang a number on a company, duly exercise discipline and patience are useless if you can't pull the trigger and bet on your convictions. Almost by definition, terrific investments are not available unless the vast majority disdains them, and you're alone with your appraisal and your qualitative opinions. If you're not willing to look stupid in the short run, you're not going to be a great investor over time. That means that if you're not willing to show a loss, if you're not willing to stand apart from the crowd and pull the trigger when your value is 100 and it's selling for 50 and everybody says you're an idiot, if you aren't willing to trust your own appraisal and your own assessment of management and businesses compared to their business, you're not probably going to be a very profitable long-term investor. Graham said you're right or wrong based on your facts and your reasoning, not because someone that disagrees with you. Mr. Buffett has admonished, quote, if you aren't certain that you understand and can value business far better than Mr. Market, you don't belong in the game. End quote. On portfolio construction, and we're past the 6 major fundamental requirements. On portfolio construction, we like what John Maynard Keynes, who has a spectacular investment record managing several insurance company portfolios, and the King's College Foundation wrote to a friend some 80-plus years ago, quote, to suppose that safety first consists in having a small gamble in a large number of different directions, as compared with a substantial stake in a company where one's information is adequate, strikes me as a travesty of investment policy. Buffett has said, diversification is protection against ignorance, but if you don't feel ignorant, the need for it goes down drastically. End quote. Our accounts have owned 15 to 20 businesses over the last 35 years. Statistically, you can eliminate about 90% of the individual business list with 12 names if the companies are in different industries. Ben Graham, John Templeton, Warren Buffett, Charlie Munger all contributed importantly to our culture and to any investment abilities that we have. Additionally, there's a book that I'm sure is not one of your reference materials, but it's been a source of wisdom for Southeastern. The name of the book is Don't Squat with Your Spurs On. Written by a famous Texan, Texas Bix Benzer. It's a compilation of terrific one-liners, 6 that I'll share with you. Number 1, honesty is not something you should flirt with. You should be married to it. Pertinent to investing, so you need to be straight with your fellow men, and most importantly, you need to be intellectually honest with yourself. Mirror is a good tool. 2, quote, no matter who says what, don't believe it if it don't make sense. Said differently, use your common sense and apply rationality. Remain skeptical, but don't become cynical. Skepticism's great. Tilt over that and you find yourself rejecting good things without being rejected. So trust your own assessment of facts is maybe another way to say it. And not what someone else is telling you. Draw your own conclusions. 3, too much debt doubles the weight on your horse and puts another in control of the reins. I've read in the recent times investment banks, commercial banks, leveraged hedge funds, private equity, CLOs, CDOs, and other recent leverage creations. Extreme leverage sets you up to fail and positions you to be a liquidity seeker at the most inopportune times when adversity arrives. So when adversity arrives, you want to be in that position of offering cash or someone else's issue. 4, the quickest way to double your money is to fold it over and put it back in your pocket. So, as I was saying earlier, there's little long-term cost in holding liquidity, and it allows you to quickly build your capital when the impaired are willing to pay a high price for it. 5, always drink upstream from the herd. I'll be thinking out there where that blue line is at the end. Focus on what the business will look like in 5 years using all your tools, order model criteria, etc. A long-term investment time horizon puts you in a tiny minority of market participants, and I might add, defers significant tax liabilities. One of the reasons Mr. Buffett's one of the richest people on earth is not because of the use of the float of the insurance companies, but it is because of that and also because of the big deferred tax item on his balance sheet. That means he's had the money, it's been compounding, and has not been sent to Washington. I.e., you don't see any tax liabilities on that red line until you get to intrinsic value and it's 15%. Not this frenetic trading where you're paying the 15 by the month or by the week. That long time horizon defers significant tax liabilities and allows it be on your balance sheet. 30 years ago, the average holding period for New York Stock Exchange companies was 5+ years. Today, it's less than 6 months. So I think you can draw from that why looking out over a long period is beneficial. 6, coolness and a steady nerve will always beat simple quickness. Take your time and you'll only need to pull the trigger once. Think Berkshire, Southeastern, 20 baggers that have been in the portfolio 20 years or more. If you get it right on the front end, it's not a lot of work. You're just constantly rechecking your assumptions, your assessment of the company's competitive position. You get more and more knowledgeable about the partners that you have running the business. And for us, we're actively involved with them and supporting them. So that concludes the prepared remarks. I want to say, over time, the qualitative has become much more important to us than just the P/V, as we say in our shop, the price to value. Because the price to value is on conservative metrics. It's based on what we know now. And the longer we've done it, the more important, we think our management partners are. The more important the competitive characteristics of the business are. And you do want it all. You want to steal it, you want a great company, it's a monopoly, you want Warren Buffett reinvesting in it, and maybe you want to go to let it run it. You don't get that. You don't get black and white in the investment world. Usually it's shades of black and white. And you want it to be as close to perfection as you can get it. And that's why Graham had it so right when he talked about the margin of safety, because if something goes wrong in your appraisal and you bought it at 60 cents, 50 cents, you got a big room for error. There are 2 forms of margin of safety for us. One is the P/V, if you bought it at half the value. The second is in the qualitative side. Business gets better over time with more information, more market share, better pricing power opportunity growth. And hopefully the people learn and grow and become confident in time. Questions?
Just on this last point, understanding that the qualitative factors certainly play a huge role in deciding whether to keep a name in your portfolio, do you have a certain threshold for P/V that you look at, or do you sort of compare to what other opportunities are out there in the market?
So, exit, is that the If you read the thing in the Greenwald newsletter, we talked about it. Clearly, the business gets to 100 cents of the dollar. There's no margin of safety left. We sell nothing else asked. On making a switch from an undervalued to a new undervalued investment, John Templeton had something he called the 100% rule. And let's say a business got 80% of the appraisal. He wanted to be able to buy one at 40%, assuming all qualitative things were comparable. The reason for that 100% improvement in the P/V relationship is because of 3 things. Back in his day and time, you had to pay big commissions, and you had market impact cost as well. Secondly, you had to pay taxes and drag fewer dollars into the 40-cent P/V. And thirdly, you had to be right on both appraisals. I mean, approximately right on both appraisals. So we do make those swaps from a more fully valued to a lower, to a more discounted investment. But we like a big improvement in order to, quote, move the furniture around. And the third would be if there's impairment to the business. And usually that occurs slowly. Or we prove to have been wrong on our assessment of the management. And so if it's the latter, if we're wrong on the assessment of management, we have 2 options. One is to vote with our feet and live. and the other is to replace them. And if we assess that replacing is either too difficult or too expensive, we're probably going to leave. But today, it's easier to replace managements. But we hope not to have that issue. You want to go in thinking you're right about your partner. So those are the kind of the four ways. We sell when it gets to full value. If we can improve by big margin, we do it. If we think the impairment of the business is ongoing and it's going to denigrate our appraisal, our value long term, we basically made an assessment that we were wrong about the evolution of the company. And then the fourth would be if management turns out to be less honorable or less capable, or both.
What's the philosophy behind having everybody be a generalist versus industry focused?
The question is why are we generalists instead of slotted industry assigners? We want the best investment at the margin, regardless of what someone's assigned to. So we have 10 people that can look in any silo, and they're rewarded for finding the next great investment. Business people price, high quality companies, good management teams. It we think uncovers more opportunity. We turn over more stones more often. And at the end of the year, if you haven't found anything, it's not because you've been assigned to some utility or some car company. It's because you had the world to look at in terms of businesses, and you had even another world to look at amongst the capital structures of those businesses. So we just think having individual freedom and the right set of incentives for people provides the best outcome. But other people have been successful with I don't think Buffett has an industry assignment. We feel that he's been pretty successful looking around the world at various industries and various asset classes. And that's, we want to be open-minded, and the broader your spectrum of pursuit, I think the more probably you're going to be finding something that has a good emotional safety and it's going to compound. Yes.
Could you discuss a little how you get comfortable that a company has a competitive advantage or is competitively entrenched?
Well, the acid test is pricing. If they can price consistently their product vis-a-vis their peers, their competitors, that's the answer. And it shows up in returns on capital, long term. And usually it's big market shares or unique advantages, whether it's brand names or patents or geographical advantages, so you own the rock tip and draw a 300-mile ring around it. You don't get pricing because nobody's coming in that ring to lift your trucks because of the cost of all the rock. If you happen to be on the Mississippi River and goes up and down barges, and people's circles get shrunk. So there are a whole laundry list of things that give companies competitive advantage. Networks become pretty dominant. Watch FedEx go from a small little bitty idea to an incredible worldwide network of many participants. Now there's really two. We just ran the third back to Europe. Now it's two operating on the oligopoly. By the way, you left Fred Smith that I Bruce when you're talking about.
Oh, right.
He would be really pissed. He's a good guy too. So, yeah, that's everything. You want to find a company that has a competitive advantage that's really hard to do.
Mason, could you talk about, are you willing to talk about specific companies like, for example, Dell? Or any other companies that you're interested in? Mason,
That's Bruce's question, Nick. We'll take all specific. We'll tell you if we can't talk, if we've got a deep following, we're going to find each other and we won't talk too much. But, sure. Dell. Bruce and I disagree on certain parts of Dell. Dell has an old business that has been somewhat threatened, and that's the old just desktop computer and the hardware, the PC, the laptop, and the servers are Dell's main hardware business. And to the extent it's the direct model to the corporation or to the university or to the government, Dell has very significant competitive advantage. And their competitive advantage is that it is produced to order. They get a check. They give you a promise if you're a business person. And in a couple of weeks, you get the machine. The best negative working capital in America. Huge, huge benefits. Cash on the front end, services delivered, product delivered, and then you pay your vendor, Intel or whomever down the road, 60 days. So we always love businesses that give us cash where all you give them back is a promise, whether it's insurance or debt. And so that's their original business, and there are two major additions to that. Software and services. And the software and the services have become the overriding business portion of Dell and will continue to grow. And their focus is in the small and medium-sized business. And they're letting IBM and Accenture and HP battle out one another for the Fortune 500. And Dell is very happy to ship their machines, their servers, their desktops, their laptops to Southeastern Assets Management's 55 and work with our IT group. And we are very happy to pay them their fee for backup. So anyway, Dell's a $14 stock. They should produce, we believe, this year about $1.80 for free cash flow. There's over $5 a share in net cash, and they're producing almost 50 cents a share, close to it now, of that a quarter. So if you strip out the cash, you're paying $9 for approaching $2 free cash flow per ton. And we believe that in 2010, you've got three major drivers to tilt the world in Dell's favor. One is Microsoft 7 rolling out. It means you're going to order a lot more machines and service contracts and software to order those machines, and that works really big for Dell. Secondly, these things are broken. Corporate IT departments haven't spent any money in 3 years. And so you've got a catch-up just to replace broken systems. And thirdly, you've got 6.5 billion people on Earth that are going to get online and use these machines either in small businesses, medium-sized businesses, or individually. And so that's the secular case. So those three drivers of top line, bottom line, what have you. And there's a very big misnomer about Dell. Dell is 85%. What I've said, only about 15 to 20 at the most to the consumer. All of the literature and the media, whatnot, talks about Acer and Hewlett selling their machines. And that is not what we're focused on. I mean, Acer made $100 million. Dell's going to make $4 billion. Michael doesn't care if he sells a single PC or laptop to the consumer. He's interested in servicing those small, medium-sized companies, governments, universities, having long-term service contracts, selling them software, solving their problem, and hardware is one way to get that done. And they make their money at it because it's made to order and because of that working capital advantage. Contrast Dell's delivery system with that of Hewlett on the consumer side, and Dell would not do a consumer sale if they weren't trying to keep the brand in front of people. But in the case of Hewlett, they have to produce the machine, give it to Best Buy and to Staples, and wait for Staples to sell it, and then wait for Staples to pay them back. So it's the reverse on a working capital basis to where Dell is. So Hewlett has to produce the machine, send it to the retailer, wait for the retailer to sell it, and wait until the retailer feels like paying them back, like Walmart will delay them long as And that's not to say they can't make money doing it with long-run common machine production. And it's a completely different business. And Dell's doing some of that long-run common machine production, delivering low-end or standardized boxes. So anyway, that's more than one thing. But it cash wins. Cash flow production per share wins. And you want to think about the DuPont model when you're assessing businesses, assuming you don't re-leverage. You want to think about top line, margin, tax rate, shares. And you want to think about those things in the DuPont model and what they'll look like out there 5 years from now. So when we think about Dell, we go down that list of the DuPont model requirements, and we even add some to that because of this huge financial flexibility. Being in a position to be a liquidity provider, as you said, Michael has this $12 billion net cash on the balance sheet, producing another $1.25 billion to do with. And one to do with right now would be to really shrink these shares from $2 billion down to $1 billion. And if he does it today, the value per share growth really goes up. Goes up because if your sales and your margins move north over 5 years and your share base goes down by half, you've got a lot of per share value to it. And so that's the for us. Yes.
Just to see how we apply, you mentioned in an earlier question that like to see competitive advantage, you should always see if the company can price the product. In the case of Dell, if you look at the hardware section, they don't have like a lot of room to price it, like when you see long term, because like they have like the Intel chip, they have like the suppliers and all that, anyone can do it. Why do you think they have competitive advantage if they cannot price the product?
Well, you have to look at their margins over time. And pricing does not mean absolute, it goes up every year. It's pricing vis-a-vis your cost structure. So you're really talking about pricing sufficient to give you margin maintenance or growth. Okay? Now, if you take Diageo, we're talking about 2x the market share of the next company in the distilled spirits, the liquor business. You're going to see absolute pricing. So you got it sitting in a cask and it's getting old and it just sits there. And you got your warehouse pretty much and your ingredient cost in front of that's done. And you see 3-4% long-term pricing in absolute terms. That's pricing you're referencing. But there's pricing power in a lot of businesses that have rapidly declining cost curves. So it's pricing relative to your cost that matters.
How do you see software based on the internet and computers able only to access internet and use these softwares as a competition to Dell? You have like a lot of new computers that are able only to access internet, and apparently Google is moving to offer free software on internet like spreadsheets and WordPress assets. How do you see this competition for them?
Well, that's a very good question, and there's been discussion about computing in the cloud for a long time, and Dell sells one heck of a lot of servers. If it tilts in that direction, where you get past the safety issue of being willing to put all your data out there in the cloud and bring it back, and compute out there and then bring it back. If you get past that, businesses getting past that, not having it on their servers physically and otherwise protected. We believe Dell's server load is going to be very dramatic. Where Dell is that, they're working with many companies on many different solutions on the software side that are specific to their companies. And so far, at least, they've been unwilling. Most of these customers have been unwilling to, let it wander out there. But it's something to monitor. And it is an evolutionary issue for us. Think about it a lot.
Do you think having your business located in Memphis has provided benefits for you over the long run? And if so, what are they, and any challenges you face as well?
The questions about location, it doesn't matter where you really are. I remember 30 plus years ago, I said, well, we'll get them. Now you don't even have to wait on the post office. It's what you do with data. And as I said earlier, it's a qualitative assessment of people in competitive positions that, and how far out you're willing to look. It's easier to be right out a few years than it is over the next 39 days. Sure. And so all of these prices swing like crazy based on opinion on the quarter. Boy, that's just nirvana for people that are trying to assess the long-term competitive advantage, what the value's going to look like after 5 years. All of a sudden they swing, stock down by half. It's all based on disappointment amongst people focused on the quarter. So I think that being in Memphis gets you away from all that static. The best thing you can do is have quiet 3 times a week. Not so to the extent that you're inundated with other people's opinions. That's yes.
Do you incorporate macro trends in your models, like macroeconomic trends in your models, or just when you're thinking about a company or something?
We build a macro into the company. After we go major under Cemex, obviously we know a lot about what their domestic market looks like in Mexico and how that economy affects them, oil spending for infrastructure projects. So you don't ignore it, and you try to build in, what you know about the way that these businesses operate into your appraisal. And it doesn't mean that, we know what the Fed's going to do in terms of short-term using or long-term, defending the dollar or whatever health care is going to pass or what interest rates are going to do within the range. So we don't spend a lot of time on what's the unknowable. We try to spend all of our time on what's reasonable in there. That's one of the real challenges. There's so much stuff out there that doesn't really change this. And, did we forecast the financial crisis? No. And we had some of our appraisals were harmed because revenues were deferred. I can fortunately say we didn't have any of those. We didn't own that. What happened. And in fact, that financial leverage, banks 21. Every bank fails. Every bank fails. Because over time, you're going to have a guy that does something wrong with 5% of the assets. There goes all your equity, and even you got to be reconstituted or taken over the work. Wow. So, anytime that's back to, the leverage thing. Banks are no different than how we leverage to other entities. It doesn't take much of a problem on the left or right-hand side of the balance sheet.
You talked about the importance of management. How do you assess management? How much of it is qualitative? How much is quantitative?
Both. You want to go back and read all the annual reports where this management is in place. You want to see what they delivered: revenues, margins, returns, share repurchase. Do they act like owner-operators? Do they do everything on the capital allocation side at the margin when it's important? The other is, we read everything written about them. We literally have dossiers of everything that's been written in the local paper about them. It's the personal and the, how finished they are and what drives them. We said, it's impossible, cliche, to do a good business deal with a bad person. And it is. You want people that are trustworthy and secondarily really capable. So, on the quantitative, you want to see what they've done. It's highly probable if we've done good things, they'll do good things in the future. Although we've had people who never made a mistake and make it as soon as we buy a company. But anyway, the odds are greatly in your favor if they've delivered good results and if they treat people well, they have good compensation plans. You get what you incent in most cases. So getting the incentives right for top management and the others is imperative. So not only do you want capable people, but you want the proper set of incentives to drive the future results. We like people to make a lot if they deliver and very little if they don't. We like them to get it to cash and not shares or everybody. So you can't read too much about your particular future partner, and you can't read enough about his own record.
How much of this is meeting with them, and how do you prepare to carry out those meetings?
Yeah, Bruce knows we want to look them in the eye. And the first question we ask them is, what's your worst issue and why? And, if they don't have an issue, then you just kind of turn around and nicely leave. Everybody's got an issue. And that's businesses solving problems. So, first thing we do is go to the proxy statement, see how much they own, how much they pay themselves, what can work for free and unlock. That's pretty basic. And you get a lot better outcome that way. So get the incentives right, partner with trust, and people that get it, that know that their mission is to build value per share with low risk. Period. While they're there. And you're giving them your proxy. Do with your capital. So we're pretty passionate about them doing the right thing. We're quick to file a deed. Say that, we want a director if we think it's necessary. Yes, sir.
I think they some emphasis on the 5-year horizon for allocated return. So do you have any examples of investment decisions you made on a shorter term and then you employ a different strategy?
We have been short-term investors, but not intentionally. Clearly, the quicker the red line matches the green line, the higher you return. And we have, when you shop in a pond of 50-cent dollars, good things happen to you. The management can say, we'll pass the hat, we want to take it all ourselves and take it private. They can say they want to liquidate it and give all the assets out to us in cash. Merger and acquisition, private equity can tap on their shoulder and say, well, by golly, we'd like to take it. And then, another industry transaction of a similar company could be the catalyst for the public market recognizing it in a quicker period of time than 5 years. So, yes, we've had many beneficial short-term surprises. But, you want to go in with the view that you're going to be there for a long time, and you don't want to commit for being a long-term investor unless you got all these forces working for you, building your value per share as you go through. But anybody that thinks they're clairvoyant about how the market's going to weigh it next week is misleading. They tell you that.
I'm curious if your macro view changes or becomes more important in countries like Japan.
We've been there for 11 years with an office. We made a lot of money in the Asian crisis in '98 when we took our little $50 million and moved them along with international. And we bought nets and got businesses for free. So that's been the driver, being able to find a dozen companies that are really, really cheap and hopefully some good businesses behind them. Cash. If the cash is already on the balance sheet, you don't have to produce it. So the investment risk spectrum goes up the more you have to produce the future and bring it back to the present. And in Japan, we were there getting all the cash for less than we paid, and the business was on the side for free. And it was at a point where everybody said, Japan's never coming back. And, the Asian crisis was causing their surrounding countries, Thailand, etc., Malaysia, to have major issues. I do believe Japan is becoming a more shareholder-focused country than it's been in our history, being involved with businesses there. They're thinking about returns on capital because they know they need to attract world savings to help them solve their demographic challenge. There's no doubt that they're getting older. Everybody knows that. And so their imperative is to start earning higher returns on capital, to attract more capital. And that this has taken them a long time to understand. The Japanese historically have tried to buy market share at any price, which meant they had low returns on capital. They're coming around to knowing that earning high returns and treating shareholders as partners and fairly is part of the long-term solution. So we wouldn't say that they're in the ninth inning of shareholder focus, but they are further down the road.
How do you get comfort estimating the growth rate of the company, or maybe its market share, particularly when you get 8 years out in your estimates?
Let me say this. You want to build a model that's so conservative that anything surprises in the ups. We'll take Aon, one of our favorite companies. Just repurchased it.
Does everybody know what Aon does?
Aon is the largest insurance broker in the world. They used to be a combination broker and insurance company. Started by a guy named Pat Ryan. He had a company called Combined Insurance. He went from being pure insurance to buying a bunch of brokers, and then finally a fellow by the name of Greg Case came in, and they sold the insurance companies for $3+ billion. They took all $3 billion. They bought their shares in, and they are now the largest insurance broker in the world. They surpassed Marsh McLennan. Third in the market is Willis. And so Aon is a insurance broker. Insurance brokers place risk for risk assumers. Whether it's an oil rig in the North Sea, or whether it's wind damage in Florida, or whether it's earth shaking in California, people want to transfer risk. If there's anything I want to grow portfolio on for the next 20 years, it's risk transfer, because there's more risk, and they're growing. And as people become higher earners and real incomes go up around the world, there's going to be more risk and more businesses to take care of. So in our model for Aon right now, we're assuming zero growth in terms of price for revenue. That is, insurance brokerage fees and insurance brokerage commissions. However, in 5 years, we believe our zero revenue growth on the front end of the first 5 years, the first couple of years, is really conservative, because as the economy comes back, there will be more units to insure. As we get an earthquake like Chile and or a combination of storms, insurance rates will go up. So you get more units and more price. So we believe our revenue growth in years 3 and 4 could be a lot more than years 1 and 2, which we got it flat. So you want to build in, based on the past, the future. And our future is currently booked at less than the past. Insurance brokerage revenues at Aon have grown GDP in the past, but we are booking them at zero right now. So we believe 3 things give us more than zero for the next couple of years. One is that the economy comes back and you get more units to insure. Plants, people, you name it. 2, it's problematic that it's doubtful that insurance rates will stay low for a long period of time. And then thirdly, we believe that there's just going to be secular growth after that, I spoke of. So what you want to do is build a model that gives you less than reality. We believe their entry into China, India, and Brazil adds significant unit growth to the model that we just talked about. So that's another of them. New markets, okay? Whether they'll be models successful or not, we don't know, but we believe they will.
Then how do you get a sense of what the intrinsic value would be in order to sell it, if you've got, in order to grasp what India and China, the value of those are?
Well, we're not giving anything for that. We're saying flat revenues the first 2 years, and then growing about GDP in years 3, 4, and 5 out. Secondly, margins. They operate at a 21% margin, and their peers are at 25%. We're not taking margins. We think they get margin growth because they have a new computer system that can price every risk every day that is written, and that they have some redundancies in the cost that they can take out some good margins. Tax rate, we're not changing that. Don't think it'll change. Shares, we told you they bought $3 billion worth of shares in. They just got a $2 billion authorization to take shares down, and we believe very strongly that'll happen. It's not built into our appraisal. Our appraisal gives us a P/E of about 65 cents on the dollar. And if we are realistic about what we believe out year 5, we believe revenues will grow more than our model, we believe margins will get to 25, not stay at 21, and we believe shares will go down by $2 billion in the first 3 years, not stay flat. That gets us to about 50 cent dollar. So we've got a range here of today's value and then what we believe is most probable. The most probable is above the conservative appraisal that we used to, that we did use to buy in the 30s and 40s. So, again, you take the past as some indication of the future, and then you start looking at all of those components of what you believe will drive the free cash flow coupon. Free cash flow coupon at 800 days, $3.07. We believe that it can double in a 5-year period because of that. But that's not built in. If we get it, we'll be really excited. And we believe being the #1 broker in the world gives a huge advantage because there's so many nuances and subsets of insurance that when you want the best price and best coverage, you're going to go to the market that provides the most options. So in Aon's case, they deal with some, I think, 1,700 insurance companies, and each specific risk assumption of the insurance world, I think they've identified those top 5 that will provide that coverage at the best price. And each time, if pick a company, an international company, they want plant coverage for fire or hazard or personal injury or what have you, they're going to go to that carrier that specializes in that coverage and depend on Aon to market one carrier against the other to give them the most coverage for the cheapest price from an insurance company they can honor the claims that will pay the claim on the first. We like gross profit royalties on growing revenue streams. Is my answer to your question. And as you build in a conservative revenue stream, and you're going to be surprised as time unfolds.
You've mentioned leverage and debt earlier in your lecture. What does it take for you to get more comfortable with companies that are more levered? And one company I had in mind is DineEquity. What were some of your thoughts relating those two issues?
DineEquity. Yeah, that's a good one. That's a really good question. DineEquity is a company that used to be called IHOP, and when current management bought Applebee's, they didn't know how to put a new moniker on the business, so they came up with DineEquity. Poor choice, but nonetheless. IHOP, the International House of Pancakes, we owned it. There was a fellow there that just was the best operator in the world, but he was a terrible capital allocator. He insisted on owning all his real estate. And we finally got another manager, this lady, to basically get rid of the real estate, and so it's now Gross Profit Royalty. They are a franchisor of IHOPs. And I mean, it was going on a charm. And she was so successful making sure that franchisees operated well and paid their franchise fees too. Great thing, growing revenues, growing free cash flow, and fixed cost as the franchise deal. And She came from Applebee's, she couldn't stand it, she bought out. Therein lies the letter. Same model. She hopes to sell the Applebee's and turn it from an owned operating kind of business to a franchise business. And, on the way to the finish line, something called a financial crisis happened. And so all of a sudden, the franchisees couldn't get the financing to buy the Applebee's. So that's been deferred somewhat. But, we believe that market will again open up. And so far, their free cash flow coverage, their EBITDA, the interest, and principal performance has been sufficient to buy the time. So they haven't busted any covenants. They've got enough cash flow to continue on as they are without the franchisor selling their stores to the franchisee. It is one of those that your appraisal swings because there's operating and financial leverage. When you combine those two, you get quite a swing of what their integrated business is. And it will be resolved, we think, in the next couple of years, or maybe sooner. And the markets are opening back up, and there are going to be few stores financed. And clearly, there are huge pools of money that want to finance good real estate. And, they've proved to be good operators, so they release one line on their debt service. So Nine Equity has been a huge winner for us in the last year. The stock's gone from, I think it got to 8, it's now 48, 46 something. And it's worth par if they can do what I'm just so, but it does have, of all of our companies in our small cap fund, it's kind of the publicly traded, somewhat akin to private equity investment. We didn't incur the debt, but we were there when it got incurred, and again, courts still out as to whether she will be successful with her debt. She bet her career and her capital. And it's one of 19, I think, companies in the Park Small Cap Fund. So far, we're very happy with her bet, but it's, in the early days, it was pretty painful because she was taking on before the prices hit down. Yeah, market loss, but not on account of loss. Julia Stewart is her name. She's a very good operator and very determined. She ran the heck out of Applebee's and went off the rails the day after she left. And so she bought it right, but she had to borrow money to do it. Any more?
Yeah, can I ask, because are you guys finished? Because I have 2 more. I'll hog the time if you don't mind. The first question I have is, as you've evolved over time, are there any incidents that stick out in your mind of investments that really taught you something?
Sure. I guess the thing that we learned over 35 years of Southeastern is that we've evolved not unlike, we made so much money in net plus 20% of PP&E and net value appraisals when we started. 73 and 74 was horrific for the investor. And we stole companies just looking at balance sheets. You didn't have to think. You just, one of the things I did when I was in undergraduate school is I went through the S&P stock guide. And in the S&P stock guide, you had net assets, net liabilities, long-term liabilities. And you took them out. And also had cash. And it was very easy to go through the whole stock value, S&P stock value, and you can do it in about, say, 2 weeks. You went through every line and just quickly putting up, no computers going on, and figuring out where the nets or the less than cash investments were. So we began at a point where we did less than cash, net nets plus 20% of people in business, or other statistically cheap businesses in the public domain. And you didn't, and so, the quote cigar butts, I mean, you got a lot for very little, but you didn't have much of a remaining business after you got some value recognition. So we have moved away from that to this picture, which is one of owning better businesses with qualitative characteristics that we've spoken of that are very assured of growing their intrinsic value. And they get cheap occasionally, and if you get that, it's that punch card of 20 that Buffett talks about. If you get Diageo twice or once in a lifetime, you better not miss it because it was 2x the best ever when the world growth got more consumption, or like an Aeon, or like a FedEx, or I could go on down on a number of our businesses that we own that truly are unique in terms of their competitive characteristics. So if you get a chance to put significant dollars in those at 50, 60 cents, and you're patient, you're going to make a lot more money in 5 years than if you have to swap around these cigar butts, especially if you're a taxable investor. So I think, that's not to say we made some mistakes, you learn from doing mistakes and all that. But the big thing that we've gained appreciation for is better businesses, better management. The qualitative is becoming more important to us than just the quantitative. You want both, but that's the number one lesson I think I personally have really appreciated. And patience comes with that. If you're not patient, if you aren't willing to earn 1% or less on two days for a while, until you get one that's clearly a great business at a cheap price, with a board and a manager that you
Okay, last question, because unless somebody else wants to take it. You mentioned 2 industries that you didn't want to have an animalist in: utilities and automobiles. Well, you want to describe how you feel about those really quickly?
We've said that capital intensive, labor intensive has the major headwind. And yet, Mid-America Energy is very capital intensive. You only get certain rates of return on equity being receivable by the regulator. But underneath that major capital intensity is a very high degree of certainty that caused Mr. Buffett to, all of a sudden, stack up a whole lot of money in pipelines and utilities. And we've not gotten there.
So if they write their papers, you would not have them look at electric utilities or...
Well, no. I mean, they're smarter than we are, so they may understand it well enough. But historically, we thought that we could do better on our capital with higher returns going in, where we weren't dependent on a fixed return. We'd love to buy a company that has a 15 ROE going to 20, and no one telling us we can't get there if we gain scale and competitive advantage and have good management decisions that give you that big reward. I might add, the bigger pool of capital you have, the more you're forced into less than ideal endeavors.
Nelson, thank you very much.
Okay. All of you.
Especially like we'll go market this our exclusive. Are you gonna?
I think in a lot of ways, it
mentioned that in the
and your downside's a lot higher.
Yeah, I spent 8 hours on stuff.
It's already. I'm sorry.
I was kind of curious about these changes. I mean, if you have something up there, I don't think a lot of is that an upside to it? That's an upside.
They give you the things. I think there's people that's what I see. Yeah. The job is in the US.
6 studios.
600 million dollars.
I don't think in the US has a role like that.
That's a good point. I mean, he did actually have 2 transfer.
No, but you see, if I understand,
at the time,
at the end of the I don't think it's a it's how much is there?
They just stay friendly, play ball, do some.
What's a big? That's another thing.
It doesn't mean they don't have to play.
It's just a simple. That's the max. So if they continue buying back,
He's like,
then you got to
Six is good. Okay.
If it starts getting bigger than that,
It's the networks, right?
No, but why do you say that? No, but I don't agree with that. I disagree with
huge proliferation
because there's going to be it's going to be a similar market.
in this.
It's going to be.
I also think that
we're not going to go this kind of stores.
there's nothing so much as just any of these stations. Like take TNT and the NBA. Where's the value proposition of TNT pushing the NBA? It's really the NBA. So I think that there's enough of content, and as a user,
it's a problem.
I'll watch a good show with a good channel. TNT, I'm not sticky to TNT. It's 100% problem. I think there are some people that I don't
TNT you should less so, even though it goes there.
Yeah, but you know, I think
that's why a lot of people
they're still making money in their stores.
And
and they want, this question control media, yes, perfect internet, maybe we'll take.
Well, I'm not disagreeing, and I didn't say this in my opinion, but everybody talks about like disruptive technology and the internet. Because the companies that are competitive, like I think there's a bunch of media companies that are competing efficiently. That's what's just the internet. So of course, it's not going to change. Who are good at aggregating? If you talk about the internet or cable TV, but just as good as the reason why have a franchise. And that's the question: is how much of your programming are they actually responsible for developing the product? And what I said to something like a TV is, I said, look, they might get a few hit shows, right? A lot of it is purchased content, right? So they might have the
movie library, which they feed through.
So the movie library, I've gotten it. Was still but then what I said is, as far as the networks, there's nothing to stop you from changing the channel. I think HBO is somewhat sticky, and I think it's made more sticky by the fact that because they have subscriber base, they can pay more for the monitor.
I would say it's probably getting out.
They have a 35% market share. And as long as they keep delivering good content, because they have such a.
They have a few hiccups along the way, I'd say.
Well, God forbid they go acquire the China stores in China, which have 800 sensitive stores in the shape one, but yeah, you're fine.
But
that's what you mean. Oh no.
I think
I don't think it's a bad business. I just don't think it's sustainable competitive advantage.
Well, I don't know my computer science.
I'm not sure I'm there. I'm not sure I've seen it.
Yeah, I do. I'm going to grab some.
That's why it's
I'm going to wait for you back. Go home and
well, I just wouldn't bet.
I just said small business.
Well, I think we stuff it in the price. The thing is, like, the price is we're not getting a lot of credit. You're giving it back. So I don't want to go. I think that's scary. Not a short
I appreciate that.
He does have things to do. He does have class.
See you guys.
I want to share.
I mean, we were just talking Time Warner was the security analysis.
I hate class. It tells me that I'm still in class.
Yeah, no votes in that. You have to write if it has a competitive advantage.
Yeah.
You get that? Does everyone have that? Or just like?
Well, I didn't write it. I just I just did my notes.
I'm trying to remember someone else was telling me about Time Warner.
Yeah, everyone in class.
Cool.
But she played actually better.
All right, that's a good one.
Take it easy, man. See you guys. Dude. What do you think?
Right.
This is choice moment with February 2nd, right? Yep, see it.
Brent, what were you saying in the email? I'm sorry, I saw it, but I was in class, so I didn't fully read it. You wanted for our earnings quality project in 2 weeks?
It's due in 2 weeks.
The whole thing, I think so. I mean,